Imagine banks handing out mortgages like they are candy, giving loans to people who can't afford them. Then the inevitable happens. People who could never pay in the long term stop paying. Banks start running out of money. Some close down. The whole system comes close to collapse. That's basically what happened during the financial crisis between 2007 and 2009, and it almost broke the global economy. But how? Let's break it down. In part 1 of this 2-part series, we will start with the economic background in the US, then we will zoom in on the housing market and the bubble that started growing in the mid-2000s. Then we will find out how and why the infection spread throughout the global economy. In part 2, we will cover what happened when the bubble finally burst. But before we start, why don't you subscribe and hit the bell icon so that you never miss a new upload. In the early 2000s, the US economy experienced a short, sharp recession. As a result, the Federal Reserve, the US's national bank, cut interest rates. When interest rates are cut, the money you have in the bank over time loses value. As a result, people, investors, banks and businesses are incentivized to take their money out of the bank and spend and invest it, stimulating the economy. Lower interest rates also mean that borrowing is cheaper. Businesses are incentivized to take out loans, money from banks, to make investments, and similarly, people take out loans to pay off big purchases, like a shiny new car, or, yes, you were thinking it, weren't you, a house. Most ordinary people can't just buy a house outright, so they get a loan, also known as a mortgage, to help them pay it off over a few decades. The bank essentially pays for the cost of the house, which is often in the hundreds of thousands, whilst you pay the bank this money back slowly, usually over 10, 20, 30 years, plus interest. Because lower interest rates made it cheaper to borrow money, more people were able to buy houses. This led to the price of houses going up. Banks in the US made a killing from this, lending money to anyone and everyone willing and able to pay. But after a while, they weren't just loaning it to people able to pay. Banks always want to increase their profits. Looking at the ever-rising price of houses, many bankers in the US soon latched onto an idea. They thought, if we lower our standards and offer loans to people less able to pay, yeah, there's a risk that they default, that they can't make their mortgage repayments. But then, if they do, we get the house, and with housing prices going up, we can just sell the house and make a profit. So, banks started giving out what are called subprime mortgages to people with poor credit, essentially loans to people unlikely to be able to pay the money back. Even though interest rates stayed low, increased housing prices and more people generally taking loans out meant that the banks were getting more money in without having to charge people higher mortgage rates. More and more of the population was able to get on the housing ladder, and banks' profits kept increasing. Everybody, it seemed, was happy. The bubble kept getting bigger. But the bankers were never satisfied. They needed more and more profits, so they bundled the loans together and sold them to investors across the world as mortgage-backed securities, which gave them more money up front to loan to people. Here's an example. Let's say That's Why Banking has 100 customers, each taking out a mortgage for a $200,000 home. Normally, each customer would pay the bank monthly installments plus interest. But if That's Why Bank bundles all 100 mortgages together, this bundle is now worth $20 million. The bank sells this bundle to investors. Now, the investors receive the monthly mortgage repayments plus the interest, whilst That's Why Bank gets $20 million cash immediately. But the bank doesn't just sit on the money, they use it to give another 100 mortgages to new customers. It wasn't just US banks using these newfangled mortgage-backed securities. Banks across the world were engaging in this predatory lending and then bundling the subprime mortgages into investments. Now, not only investors' returns, but also the bank's profits became dependent on everyday people actually making repayments on their mortgages. This process spread the risk across the financial system, and the bubble kept inflating. But what happens when people who couldn't pay long term stopped paying their mortgages? The whole house of cards was about to come tumbling down. And that's what we'll see in part 2, the crisis that almost broke the global economy. Don't forget to subscribe and hit the bell icon so that you never miss a new upload.